Hello, everybody. My name is Hunter Holsauer. I'm the director of the Smile Fund, and I would like to welcome all of you to the last Smile Fund investment strategy meeting for the year 2020. We know that 2020 has been quite the year, so hopefully we can end it here on a good note. For those of you that may be new to the Smile Fund, I'd just like to let you know that the Smile Fund is a student-managed fund. Everything is done by the students. They manage north of $750,000 for our client, which is the UC Foundation. We're extremely grateful to them for all the support that they provide. And we firmly believe that the Smile Fund is the best student managed fund in the world. So there's a lot of reasons for that, but one of those things is these investment strategy meetings and the participation and support we get from professionals in the community. So that being said, please hold us to a high standard, pull no punches, ask any questions you want. And I'll go ahead and turn the ship over to our president and chief investment strategist, Melissa Mueller.
Yeah, thanks for hopping on, guys. Like Dr. H said, I'm Melissa Mueller. I'm the chief and president. So let's just get into it. First off, from the officers, you'll be hearing a performance update, then you'll be hearing an economic update, and finally a risk update. Then we'll shift it to the analyst where you'll hear a stock pitch in information technology, a stock pitch in energy, and we'll finish it up with an industry update in healthcare. First off, the traditional funds performance year to date as of October 20th was 20.09%, and the S&P 500's return was 8.18%. This caused the Smile Fund to have an outperformance of 11.91%. This performance has been mainly driven by our heavier weighted positions in IT, consumer discretionary, and consumer staples. I will go more in depth on this later, so I'm going to move on to the trades that were made in the traditional fund. I'm going to keep this pretty high level. So first off, we entered Kratos Defense and Security Solutions to gain exposure to the cybersecurity market. We then entered Autodesk because we believe they are making a strategic decision to move to a subscription-based model. And then we also increased our positions in Salesforce and JP Morgan. And then we exited our positions in Pfizer, Essential Utilities, which was formerly Aqua America, and Pepsi. Moving on to how these trades have affected our current sector weightings versus the S&P 500. We are now overweight in IT, and we're still overweight in consumer staples, but we have reduced it just a little bit. And since selling out of Essential Utilities, we are now underweight in the utility sector. We will touch on our weightings later on, so I want to keep this pretty short and sweet. These two tables include their largest holdings and the top performers of the traditional fund. As you can see, our top three holdings of Microsoft, Amazon, and PayPal were also our top contributors to our outperformance. You can also see that Apple is one of our top performers and largest holdings. It just missed the cutoff for the largest holdings table. Going forward, our strategy for the traditional fund has stayed relatively the same. We are still confident in our top holdings, but we do have plans to fix our allocation effect, which I'll talk about later on. Shifting our focus to the strategic fund, again, I want to keep this brief as Jacob and I will talk more in depth about this later. We did outperform our weighted benchmark by 2.63%. This was driven by our positions in the small cap, consumer discretionary, and small cap ETFs, in addition to our position in the S&P 500. Going forward regarding the strategic fund, we are shifting the majority of our focus to this fund so we can really capitalize on some of our macroeconomic strategies. At the top of this funnel on the left, we have what we call our buckets, which are our allocations in small cap, mid cap, and large cap, and also international. In the middle follows our funds that target sectors and industries such as our sector ETFs. And then at the bottom, we have our individual stock selections like Orsted or Proofpoint, which we currently hold. We have historically done well with our stock selection overall, and you'll see that later on in the table. And then as you can see on the right, we have some of the industry ideas that we are either currently researching or interested in researching. And again, keeping this really high level because Jacob, I don't want to step on any toes in Jacob's presentation. So if there are no questions regarding this, I'll just pass it off to him so he can get more in depth.
Melissa, could you explain the fund ideas component here? What are we talking about?
Yeah, so this is actually something, something that Jacob will go more into.
Okay.
I don't know if you want to wait for his or if you want me to.
Okay, all right, fair enough.
Melissa, can I ask you a quick question?
Yeah.
So obviously you have a stellar outperformance. These slides look great, so really well done on that. But I wonder, with that overexposure to tech that you touch, what do you identify as the biggest risk factors that the fund's in right now? Why are you taking these risk factors, and how do you intend to monitor them going forward and make sure that you're not overexposed to too much risk?
So you'll see, and we actually kind of cover this when we talk about our strategic fund later on in the risk update. You'll see that the growth stocks had the best return and value stocks kind of lagged a little bit. So as we're still confident in tech, and especially as the work from home and just the evolving of technology, we see that as a long-term trend, and we're still confident in it. So we don't see really backing off if we still want to see those returns, if we still see room for improvement.
All right, why don't we let Jacob go? I think Melissa can chime in too after Jacob's part. It might answer some of these questions.
Yeah, so my name is Jacob Snook, and I'm the VP of Market Analysis. And today I'll be going over our macroeconomic update. Just an agenda, we'll go over some COVID-19 data, followed by the implications and policies from the government. We'll talk a little bit about some of the major events in the news, like in Brexit and antitrust lawsuits. And then finally, we'll talk a little bit more about the strategic fund, like Melissa had mentioned. Going on to the next slide, at our last ISM, we see that the September 17th numbers for the New York Times Vaccine Candidate Tracker were 25, 14, 9, 3, and 0, respectively, for each stage of the approval process. Now, just a month and a half later, those numbers are 33, 15, 11, 6, and 0. And I think it's a pretty significant improvement, especially just as the number of vaccines in that final stages of approval have doubled from 3 to 6. AstraZeneca, Pfizer, Novavax, Moderna, all of these companies are in the middle of large-scale efficacy trials. And Dr. Fauci had noted that there's a growing optimism that we'll have some sort of vaccine by year end and enough doses for Americans at the end of the second quarter of next year. Looking at the bottom graph, we take a look at mortality data, and just also encouraging, as the CDC states that nationally, the percentage of deaths due to pneumonia, influenza, and COVID-19 have continued to decline since early September. We've included those pneumonia and flu numbers just because we're concerned that surges in coronavirus cases and pneumonia and flu cases could coincide and maybe amplify the strain on our medical systems. But again, the hospitalization rate of all three of those together continue to decline since July. While the number of new daily cases is still incredibly important, hospitalization and mortality data gives us insight just to how effective we've become in treating the virus. And so that makes us think that an influx now is not as important as it would have been 6 months ago when it was so new.
Jacob,
yes.
The charts, are they through October 29th? What is that data?
Yes, so this comes from the CDC, and the data goes...
Hospitalizations have definitely risen.
Yes, so I think it may, I'm not sure if the hospitalization rate there, they've isolated the COVID-19 numbers. Percent of death due to pneumonia, influenza, and COVID have come straight from the CDC data.
Okay, let's Jacob. So so that for purposes of time, you and I offline.
Okay.
I want to see your data set and see what you're using,
Yeah.
and then just make sure we're on an apples to apples, comparison here. Okay, let's do that offline. Okay. Yeah.
Okay. Thanks. Going on to that next slide, we can kind of talk about the policy response from the government. The economy, and particularly equity markets, has been supported by this massive stimulus, monetary policy response from the Federal Reserve, and the fiscal stimulus from Congress. Fed injected that liquidity into financial markets, as illustrated by that top graph. Federal Reserve balance sheet is a percent of GDP. And Congress passed a multi-trillion-dollar relief package for unemployment benefits, support to small businesses, and all sorts of different things. To put it into perspective, new fiscal stimulus and total fiscal deficits in the US are about double the level seen in 2008. And JP Morgan projects that the US fiscal deficit for 2020, which is seen right there in the bottom chart, to be around 15 to 18% of GDP, which hasn't been seen since the height of World War II. Going on to the next slide, we can see that it's been 7 months since the CARES Act was passed in March. Many of the provisions have expired. Fed Chairman Powell said that the expansion is still far from complete, and too little support could lead to a weak recovery. And while House Democrats, Senate Republicans, President Trump, they've all released their own plans, it's really not produced any bipartisan negotiations or plans for a fiscal stimulus package. We wouldn't expect a package over the next couple of weeks, just due to the political nature and the election and the election outcome taking the forefront. Assistance provided to airlines through payroll protection programs expired September 30th. And particularly here, we can look at the TSA traveler throughput data. It can show us just how the industry is struggling to recover. It's relied on that fiscal stimulus to weather the storm thus far. Passenger numbers have increased steadily since May, of course, and it's recently crossed that huge milestone seen by that green line, checking in over 1 million passengers in a day. Even though that's great, it's still well below half of last year's numbers, and they've seen multi-billion-dollar losses. Southwest recently last week had said that they're urging lawmakers to extend the payroll support program in order to avoid that furloughment of employees in 2021. Going on to that next slide, in response to the economic downturn, the Fed is really committed to keeping rates low and near zero to remain accommodative despite inflation maybe running above its 2% target. Low interest rates are good for businesses, good for capital investment, good for consumers because it lowers the cost of financing on large purchases like homes and cars. And overall, it could increase spending and spur growth. A larger money supply translates into more spending, and which could cause prices to rise. The Fed's shift to the average inflation targeting means that the Fed would let inflation run above its 2% target to account for periods running below its 2% target instead of tightening the policy as it approaches it. And while low rates and massive stimulus could increase upward inflation pressures, I believe inflation will remain subdued in the near term. Here are a couple of thoughts on inflation. Output gap is measured here at the top by the difference in actual output and potential output of the economy. A negative output, like we see at the 2020 here, of negative 10% of GDP, would indicate that the economic output is below its estimated potential, and the Fed evaluates output gap in order just to gauge those inflationary pressures. Positive output gap might spur inflation, and that negative output gap would suggest that it's just not operating at maximum efficiency. It could take some time to recover. We see that after 2008, although we would expect a quicker recovery from stimulus and just the nature of the recession. While there has been consistent gains in housing purchases and consumer spendings, I also think that there should be continued progress in reducing unemployment and reopening businesses before inflationary pressures should cause concern. Without new fiscal stimulus, household insolvency and small business bankruptcies could increase, which would put even more downward pressure on inflation. To get an idea of the market's expectations for inflation, we can look at TIPS, right? We have seen various TIPS break-even rates here, and simply calculated by the nominal treasury yield subtracted by the nominal TIPS yield of that same duration. It's called the break-even rate just because it's the average inflation you would need over that time period to receive the same total return on TIPS as you would as the treasury. Because investors have that really big incentive to estimate that correctly, we use it as just a market implied gauge of inflation. We can see that the 2-year break-even rate is at 1.37%. The 30-year break-even rate is at 1.83%. It's important to note the difference here is only 46 basis points. And I believe it's just an indication of low expected and projected inflation from the Federal Reserve and investors. Now, you might say that these estimations are specifically relevant now under current market conditions and fundamentals, and that could be true. And as conditions improve, we would see the expectations likely rise. But there are other factors like technology improvements, globalization, central bank independence, lower interest rates over longer periods of times. All of those could be explanations for that lower inflation. Moving on, we can see a little bit about some of the major events in the news, starting with Brexit. The UK's years-long exit from the EU will finally be forced to end on December 31st, as the transition period will have expired at the time, and the extension period allotment time has passed already. Today, negotiations have moved to Brussels, and the UK Prime Minister and the President of the European Commission have attempted to broker some sort of deal. And if deal isn't reached, the UK would leave the EU's single market and customs union overnight at year end and would be subjected to some sort of tariffs and border checks within the EU. This would cause many issues, right? It would increase prices on British products and cause delays in shipments. The BBC says that the British car industry, which exports or imports products from other countries and exports a lot of its finished cars, has slumped nearly 80% over 3 years, largely due to the tariff uncertainty from Brexit. Additionally, the UK would lose the bargaining power it has from being a member of the EU and could receive less favorable trade deals. And Ernst & Young has said that over the past couple of months, the banks have moved around $1.6 trillion from the UK into the EU around these concerns. Many people say that it could be good eventually in the long run for the UK to regain some of that control over its borders, but right now, as there's no deal, investors are preparing for the worst here. We can move on to that next slide to a discussion about antitrust lawsuits in Section 230. And just considering the recent DOJ lawsuit filed against Google, I wanted to take a little bit of time to look at the potential actions against these companies. The lawsuit against Google has claimed that they pay billions of dollars to phone makers like Apple to make Google the default search engine in their browsers. And then Google made itself the default search engine on its Android phones as well. And ultimately, the DOJ thinks that because people are extremely unlikely to change that browser setting, the default browsing setting, they have some sort of de facto exclusivity there, that they have tied down the market. And this comes at a time where there seems to be a bipartisan support for more regulation on these companies. And there's been a lot of congressional hearings with big leaders from big techs companies, and cries for the actions have grown. And whether Biden or Trump wins, we believe that they would pursue it as an easy political win, but it may not be an easy win. That's kind of our point here, is that traditionally the antitrust and monopoly action is focused on price and single player dominance. So we think of Standard Oil or American Tobacco. There would have to be some sort of redefining of monopoly or antitrust or anti-competitive practices that would focus more on the market power rather than on that price. Apple and Google compete in the phone operating space. Amazon and Microsoft compete in the cloud space, so they don't really fit that monopoly description like the others have in the past. They could be potential targets of action and new legislation from an activist Congress, and that would be, targeted towards Apple's App Store control, Google search exclusivity, markets, or Microsoft's cloud dominance, all sorts of different things. Ultimately, I think that the biggest threat here would be to each company's ability to diversify and grow outwards and diversify. Amazon succeeded in expanding in all sorts of areas of its business and creating its own brands. And ultimately, if they say that you can't create your own white label brand of clothing and compete with your customers on your own platform, that could be an issue for Amazon. Looking at Section 230 of the Communications Decency Act, there's been a lot of issues here that have come to light. Just to note, this is a much smaller issue. It specifically deals with social media companies, and Section 230 prevents them from having any sort of liability of content posted on their sites from third-party users. A lot of this action has been motivated from all sorts of different factors. Specifically for Democrats, they want to battle the misinformation and hate speech online, and Republicans are saying that conservative voices are being censored. So both sides of the aisle, again, focusing on Section 230 and wanting to create some more regulation and action there. Overall, from both of these two things, we see more litigation, more regulation for the companies to face over the next couple of months and years. We can move on to the next slide about the strategic fund. A lot of ground here to cover. I just want to take some time to talk about it. Typically, we talk about the traditional fund a lot, but we're extremely happy with how it's gone this year and the performance there. And so we want to really focus here. We've created these classification boxes just to help us visualize the allocations and bucket performance a little better. In the top row, we have current strategic fund portfolio weighting on the left versus the benchmark portfolio weighting on the right. In the bottom row, I have the performance numbers there for both portfolio and the benchmark, and I've totaled the contribution to a total return at the end of each row, and in the bottom right-hand corner should be around our year-to-date return for both portfolios. A couple of key takeaways here. First, we have circled large cap domestic weightings and performance for both portfolios. We can see that the significant overweight to large cap US companies has been the driver of outperformance here, as the S&P 500 has performed really well, driven by those major players. Next, we can see that the international numbers circled and that our underweight here allowed us to avoid some of the broad-based exposure in our international funds that have performed relatively poorly year to date. Despite all of that, our Danish power company, Ørsted, was one of the portfolio's best performers this year. We think it's just another example of our ability to choose the right stocks and companies. Finally, we can see that our largest negative contributor to returns is our mid-cap bucket. It's due to a very large position in mid-cap value fund that has performed poorly at negative 13% return year to date. The value fund has been our largest drag to returns thus far this year. Going on to the next slide, we can take a little closer look at our top and bottom performers. The chart up at the top is the top 5 performers and the bottom 5 at the bottom. One of the most important takeaways here is that our value-oriented funds underperformed our growth funds pretty significantly. The mid-cap growth fund outperformed the mid-cap value fund by nearly 20%, and our value-tilted sector ETFs in energy, utilities, industrials, and finance rounded out the bottom 5. Over the past month, we've had a lot of discussions on how we can improve what we're calling a fund plan or a fund strategy. We define that simply as our approach to investing in specific sectors or industry ETFs. So this graphic might help, and this is what Melissa had shown before. At the top is our buckets. Again, the major classifications: small, mid-cap, large cap, international companies. We've done well here by overweighting large cap domestic and underweighting international. At the bottom, we have the stocks, and we've done well again through stock selection with Ørsted, Alibaba, and Benefit Technologies. And we've historically done really well with stock selection as well. In the middle falls that fund plan that we're targeting specific sectors and industries with. We believed it's underperformed because of that value tilt. Overall, we would like to make much bolder sector allocation moves here. And we think that there's a pretty good opportunity to utilize the research that we have for the strategic fund to identify those attractive industries for growth. Just to give you an idea, the majority of our research is being done for the strategic fund. 4 out of every 5 reports that we've done is for this fund. But they're smaller and international companies. It takes some time to kind of research those companies. There's less available information, and international markets have different drivers from our market here at the US. So it's taken some time, more time than we anticipated, but we believe the research has helped us identify these funds or fund ideas, and there's specific industries that have, the potential to see a lot of incredible growth over the next couple of years. So we're looking to replace some of these bottom 5 performers with the value tilt, either the mid-cap sector fund or the mid-cap value fund or the small cap sector funds with some of these. And these are all industries that we focused on at the ISMs. At the last ISM, you saw a stock pitch on Hannon Armstrong, which is a renewable energy REIT. You saw a stock pitch on Kratos, again, which is a cyber defense company. Today, you'll see Enphase and Synaptics, which is a renewable energy and technology company, respectively. And with all that said, sometimes our analysis ends in a sell recommendation. We don't like that specific company, but we still have the research on the industry as a whole, and it may be kind of attractive for that broad-based exposure overall. So while we're looking for those individual companies, and we think that's where we want to be, and we're not changing the goals to strategic fund, we want to be invested in all individual equities. In the meantime, we can utilize the research and put it to work here through these fund ideas overall.
I have a quick question on that.
Sure.
So like you've seen this reemergence of almost this emergence of thematic-based investing, especially on the ETFs, where you can get an ETF that's genetic sequencing, or an ETF that's cybersecurity, an ETF that's renewable and actively managed component about that. And I notice you have ETFs that are specifically sector focused.
Yes.
Are you proposing moving more to those thematic-based investments, or are you going to stay within these, more generic sector-based weightings to try to get access to that, or are you going all the way down to the specific security selection? Because in some of those areas, that's a lot of high risk. I'm just curious how that's all kind of reconciled together.
Sure. So at some point, we would want to kind of move out of these individual sector ETFs and more drill down into the industries. But like you said, picking the individual securities and genomic sequencing could be pretty difficult for us. I mean, they're much smaller companies. They're harder to evaluate. It's such a new technology. So even the experts really aren't sure where it may go. In that case, a broad exposure through an ETF may be better. But eventually, we do think, historically, we've shown that we can pick the right stock. So as the research develops, we may divest from the sector ETF now, go into an industry ETF for the meantime, and then down the road, kind of replace it with individual companies. So that's how we thought about it. We don't want to stay in an actively managed ETF and let someone else do the work for a long period of time. And that's kind of the thing is we just want to put the research that we have to work and then replace it with individual securities as we find them. But that's my last slide. If anybody else has any questions, I can answer those now.
Yeah, I think this would be a good time to take an open question period, 5 to 10 minutes. You can talk about COVID, antitrust, Brexit, inflation, the election, whatever you want to throw at Jacob. He is ready to go. Jacob,
I'd like to pick your brain on the inflation ideas that you proposed earlier.
Sure.
It does seem to be that we are essentially stuck in a particularly low inflation cycle over some extended period of time. Opportunity or threat for you as a fund manager?
Sure. So we've had quite a bit of discussion on this.
Mm-hmm.
Particularly, we think that bondholders have kind of moved into the equity markets as well. So it's been a benefit. They've searched for alternatives, looking for maybe investment opportunities in real estate or through equities. So it's been good for equities overall. For us, we see potential in maybe housing. Again, low interest rates and low inflation, that could be good for consumers. It's a lower cost of financing. So ideas like that we've looked at. Again, it could have implications for banks and companies that rely on that inflation rate and those yields. But overall, we think that it's good too for our high growth companies, and it could play into our ideas about the growth versus value. Having that ability to access cheaper financing is good, I think, for growth overall.
So negative implications for the financial sector, I imagine, right?
Yes, I think so. But again, I think in the near term, financials have kind of been hit with that low valuation, maybe a little unfairly. The fundamentals seem to be a lot better than they were in 2008. So I think as the recovery kind of comes into focus, there should be some near-term performance benefits from there. And I think that was reflected in the JPM increase in our position.
Okay.
How do you plan to trade against or hedge for the potential outcomes of the election?
Sure. So our view as a fund has just been that we're not trying to make any short-term tactical decisions on the election. We've really tried to focus on the long-term trends that we've seen, either in technology or trends that have been accelerated because of COVID. Again, we don't see any performance difference from Democrat regimes or Republican regimes. Even under a unified governance, it's not really much of a difference in performance. We are looking at the policy implications, for example, in energy, but energy overall, we've taken a move against oil and more into a renewable space even before the election. So we focus on those long-term trends, not making any short-term decisions based off of it.
Any thoughts on taking a position in a volatility ETF of sorts?
Yeah, that would be a good idea. We've not really had a discussion on that, and it could have been a good play over the last month for sure. But it's not something I thought about. It could be really good discussion for us.
Bento, Craig chiming in on that. I don't think it's approved in the investment policy.
Yeah, I was wondering about that.
Yeah, and then second, I would steer this group away from using products like that. We can talk offline. I'll give you my spiel why, but anyway.
Yeah,
Okay.
I would have to let Dr. H talk about the IPS a little more, but again, maybe we try to manage the volatility through the other selections.
Yeah,
It's
Well-
currently not approved in the IPS, but there is a stipulation in the IPS that allows for us to do some creative things especially in a pinch if we needed to, with some quick approval from the UC Foundation.
Mm-hmm.
So it could be a possibility, but like Ray said, it adds another layer. And right now I'm wanting them to focus more on getting this strategic fund to where it needs to be. And they've done a great job. So, and once we get that to where we are, perhaps we can add some other additional layers to the fund. But we'd much rather be really good at what we do than okay at a lot of things.
Got it.
Well, and again, I would just again chime in that this is, both of these are supposed to be fully invested in equities. I mean, that's pursuant to the investment policies. So you're judged basically on relative performance, not absolute performance. So it's all about beating your benchmarks. So if you do suffer losses in a year where the market's down, that's fine as long as your losses are less than the market, right? So I think controlling the portfolio's exposures the way you discussed, keeping a long-term focus, you can manage volatility in terms of your sector weights and your position weights, as well as monitoring what the portfolio's beta is. So, but it's a long only, fully invested in equities. I think, Hunter, you can correct me if I'm wrong, but I don't think cash is allowed to go above 5%. So I think that you're not even allowed to raise cash if you were to get really defensive. So it's a long only equity portfolio, and you're being judged on relative performance only.
Yeah, and when we've held cash, we've even put it in the benchmark just because, to avoid that cash track. But yeah, we can kind of have that conversation offline to talk about maybe volatility implications.
And I'll just end it by saying, by all means, keep asking these questions, because sometimes the students ask, can we get into real estate? And then they realize, yes, we can through REITs. Can we do some things about volatility? Are there ways to hedge or get into derivatives, where some companies actually have derivatives on their books? So there are things that we can consider in that space. But Ray is correct in pretty much everything he outlined. We do have some restrictions even on cash.
I can turn it back over to Melissa now. I think she's got a little more on performance and analysis.
Yeah, unfortunately, our VP of Risk Management, Liam, he's down with the flu, so I'm covering his portion of today's presentation. I do want to bring attention to the attribution summary tables, as I want to point out that we are currently overweight in IT, but on a year-to-date average, we are still underweight, and that is why we still have a negative allocation effect. This is a similar case for the utility sector, as we are now underweight to also address the allocation effect. But again, on a year-to-date basis, we are overweight with a negative effect. Consumer discretionary is an area that we are currently working on correcting and fixing that allocation effect. We are confident in the upcoming holiday season and believe it will be better than some are expecting. So this is an area we look to increase our weighting, as we are still underweight. We also look to increase our weighting in communication services, as a lot of the industries within that sector that we're looking at, such as gaming, that's a big one for this upcoming holiday season. Those are just two areas we're looking at increasing our weighting and making some moves in the near future.
Melissa, let's go back to this. This is good stuff, and I'm going to recommend to the team maybe spending a little bit more time on this at the beginning, at the next ISM. But the fact that your holdings show up with a couple of negative prints on the allocation effect, I wouldn't interpret that necessarily as, that you guys have done something wrong or that you've underperformed, right? What ultimately matters is, do the combined result in outperformance for each sector, right? And I think that they do, because what you do is you take the selection effect and you add the allocation effect, and you get the total effect of your active management decisions. Okay, so I think what this is saying is your underweights to consumer discretionary and information tech. Okay, you were underweight those by slight margins, but you still generated really good returns, which means that your selections were superior. So if you look at the total return of the portfolio relative to the benchmark, that's what really matters. I would submit that don't necessarily work on correcting underweights just because the allocation effect was negative. I would go with an overweight, underweight decision just based on your fundamental outlook. Okay, so I wouldn't just look at those. Those are very small negative allocation effects when you think about it. So don't guide your top-down thinking on the sectors driven solely by that criteria. Focus on the fundamentals. Do you want to go into 2021 with an overweight in information tech or consumer discretionary? That should be the question that you all ask yourself, okay?
And then one more point on this slide. This also supports Jacob's point on that we have historically chosen the correct stocks, as you can see by our selection effect. Shifting to the strategic fund holding analysis, we did fairly well. As you can see, our heavier weighted holdings performed better than our lower weighted ones, with the exception of the mid-cap value ETF that Jacob was talking about. Our allocations are relatively strong, but we could do better in investing in more individual holdings. As he just mentioned, the majority of our holdings generated decent returns year to date. I mean, you look at Orsted, Enphase, Jabil. And then touching back on the mid-cap value ETF, at the time this decision was made, we were more confident in mid-cap value because we didn't really know where the growth area was going. However, now we are way more confident in growth stocks based on small cap, mid-cap, large cap. So we do want to shift and allocate more of our funds to mid-cap growth and a few other growth areas. And if there are no questions, I'll pass it off to the analyst so we can get started with the stock pitches.
All right, thank you, Melissa.
All right, I'll pass it off to Colton.
All right, yeah, thanks, Melissa. Also, that's a good transition talking about mid-cap companies, because I've got a mid-cap company to go ahead and present to y'all. So I'm Colton Lowry. I'm a lead analyst for the information technology sector, and I'm going to be presenting Synaptics, which I recommend to be a buy, with a market cap of 2.63. So it is right there, just over the benchmark for mid cap. Go to the next slide, Melissa. Oh, actually, can you go back one? Excuse me. So yeah, to begin this presentation, I'm going to give you a brief history of the company. As you see in the price chart, the public perception of Synaptics was increasingly positive in 2013 and going into 2015, and then it began to dip. In Q4, the fiscal year 2015, revenue was up over 52% compared to the previous Q4 earnings. This gave Synaptics an annual revenue of 1.7 billion, up 80% from fiscal year 2014, just before it. So in the financials, Synaptics was posting record numbers, but the stock price just did not reflect that. Price continues to dip into 2019 until it gets revived by a change in leadership. Synaptics gets a new CEO, CFO in March of 2019, and they begin to shift more focus onto the IoT market. And since then, the company has experienced growth in two important acquisitions that I will get into shortly. So one of the main reasons I like Synaptics so much is currently changing its business strategy, right? It's transitioning out of a low margin market segment into a high margin market segment that has a lot of expected growth. From a fundamental standpoint, Synaptics is involved with developing, marketing, and B2B sale of intuitive technology, providing touch, display, and fingerprint solutions for the electronic devices. More recently and currently, the company is integrating its products to provide audio and video to the Internet of Things market. So Synaptics operates in 3 different marketing segments. That's the mobile devices, the PC devices, and the emerging and evolving Internet of Things market segment. Now pay attention to that Internet of Things market segment because I'm gonna mention that a lot, and it's a big reason why I like this company. So a quick introduction to the Internet of Things market segment. The Internet of Things is described as the network of physical objects or things that are embedded with sensors, software, and other technologies for the purpose of connecting and exchanging data with other devices through the internet. The Internet of Things, or IoT market, as they like to call it, is getting more and more intertwined with the automotive industry as well as the smart home industry. The mobile devices market segment is where Synaptics has thrived in the past, and that's why we saw such an increase in revenues from 2013 to 2017. However, the mobile devices as well as the PC devices markets are maturing, so they've just about reached ceiling demand and margins have shrunk because of it. With relatively new leadership, the company has made a divestiture of their mobile and PC technologies to allow more room for the IoT expansion. This divestiture took place in April 2020 when Synaptics closed a deal of selling assets carrying a value of $33.6 million for cash considerations of $138.7 million. As you can see in the pie chart I've displayed, wrapping up the fiscal year 2020, the mobile devices segment still accounts for more than half of Synaptics revenue, but that will soon change. And here's why. It's because Synaptics acquired 2 businesses in the fiscal year 2017. That is Connexent and Marvel's Multimedia. And they also acquired 2 more businesses in the current fiscal year 2021, DisplayLink and Broadcom's IoT business section. I broke down the marketing mix as it applies to revenue for 2020 with the pie chart on the left. That's the same pie chart that you saw on the previous slide. But just to the right, you'll see management's expectations for the marketing mix by 2023. As you can see, management is moving to a more IoT centralized business with the majority of revenue share belonging to the IoT marketing segment by 2023. And we should expect continued expansion in the IoT market even after that. As for the Internet of Things market as a whole, really, this is the next big trend for a futuristic first world society that everyone wants to be a part of. Considering previous years of exponential growth, I think it's safe to assume that the IoT market will become $1 trillion industry by the year 2027. So today it stands at a $250 billion market, and analysts predict that it will grow at a $1.4 trillion market by 2027. That gives us a compound annual growth rate of 24.9%. So here I have an example of what a modern living room and kitchen will look like in the next year or two. In this picture alone, there are 8 electronic devices that have Synaptics technology integrated into them. Synaptics technology is what gives these devices their core functions. So first, Audio Smart technology allows you to communicate to your household devices, giving you ease of control in your room and your home. In your set-top box, far-field voice recognition allows you to speak your favorite TV show right onto the screen. Audio Smart is integrated into the newest Xbox gaming console to allow voice commands. Advanced DSP allows your vacuum to hear you even while it's running. AVR services allow you to tell your fridge to order more milk, and you can even tell your microwave to add 30 seconds to your cook time. And to connect all these devices as one, you have wall panels and smart speaker assistants that allow you to control things like the temperature in your home, the lights, and many other things. Then you have Video Smart by Synaptics, which gives high quality display with the latest 4K HDR to stream your media. Video Smart technologies can be found in set-top boxes and in virtual reality headsets, which is the future of gaming. If y'all have any young kids, I'm sure they're telling you about their VR headsets. They want them bad. Even some of the same products that Synaptics used in other marketing segments are being used in smart home innovation, like a touchscreen display on the wall panels that allow you to control your home with ease. Go ahead, one more, Melissa. So that brings us to the automotive industry, which is also advancing its technologies. In this modern car, there are 6 points of inclusion for Synaptics technologies. We've got clear view display drivers, which provide ultra high resolution with state-of-the-art technologies. if you can get that animation, there we go. Right there, 3 points of inclusion for that. And go ahead with the other animation. We've got Safe View technologies, which provide enhanced visibility with contrast correction to levels of sunlight. And next, we've got ClearPad and TouchPad controllers, giving the driver control through touch and force sensing through materials like glass, plastic, leather, and other materials. A better understanding of that is like that's similar to just like the touch screen that we've been seeing on our new smartphones, like our iPhones and Androids for the past years. That's kind of the same technology that Synaptics has been using, and now they're just putting it into the automotive industry. Here we've got some notable relationships that Synaptics has already forged in the Internet of Things market. Relationships with companies like LG Electronics, with intuitive home appliances. We saw a lot of those in one of my previous slides. Then you've got Technicolor, a company that provides creation studios for virtual reality and a lot of other things in the film and gaming industries. You've also got Nikon, was developing a smarter camera for the future, and then Google that has Google Assistant and many more applications of Synaptics technology, along with Ford in the automotive industry. And I expect many more brands to jump on the bandwagon as well. Onto the valuation. Using the discounted cash flow method, I came up with a target price of $90.49 in a base market with an upside of 11.55%. Of course, to do that, I had to project free cash flow. First, I found my EBIT using the previous revenues of Synaptics, DisplayLink, and Broadcom's IoT business, and then I multiplied them by half the expected compounded annual growth rate for the market. I did that to project the revenue for Synaptics IoT segment in this coming year. I then used management's expected revenue mix for fiscal 2021 to calculate revenue for the mobile and PC segments. For D&A, I just used 2020's D&A. For net working capital, I subtracted the $500 million spent in acquisitions from the long-term average change in net working capital. And then I used that $500 million for capital expenditures as well.
Colton?
Yes, sir.
How long is your interim period?
1 year.
A 1 year interim, and then you're projecting out 1 year at 12%, and then you're running a terminal growth at 2%. That's what you did in your discounted cash flow?
Yes, sir.
Okay. Maybe offline we can follow up with each other and share a little bit more info on your DCF calculations.
Okay, sounds good.
I'd like to also better understand what you were doing with the acquisition. Okay.
Okay.
Yep.
So one of the best things about Synaptics is how relatively cheap it is compared to its peers. Synaptics has the lowest P to E ratio, as well as the lowest enterprise over EBITDA. So there's a lot of expected growth for the IoT market, and it bodes well for a relatively cheap mid-cap company to be transitioning into the market. Like any other company, Synaptics does come with risk. The risks for Synaptics are very simple, though. A systematic risk would be the market technology just not being accepted by consumers. So I don't know about y'all, but I've already seen some documentaries on this sort of technology, like your Siri and your iPhone and your Google Assistant and Amazon Alexa, just constantly listening to you at all times. Like, say I'm hanging out with my buddies and I mentioned going to get some Taco Bell, and then the next time I check my phone and get on Facebook or Instagram, an ad pops up for Taco Bell. And at the beginning, I think a lot of us consumers just thought that this was kind of coincidental, but as it happened more and more, consumers began to get aggravated, and this could definitely slow growth in this IoT market. Another systematic risk is something that Jacob hit on earlier, and it kind of backs what I just said as well, is just the stricter regulations that they're putting on these big tech companies because of things like I just mentioned, and also it's very easy for these Internet of Things devices to get hacked into. So that would reflect poorly in the income statement. Some unsystematic risks that I want to speak on is just the inability to build and maintain relationships. I mean, obviously that's going to be a problem, especially Synaptics being a big part of supply chain, being a B2B sales company. If they lose some of these customer relationships, it's gonna reflect poorly in the income statement. Another thing is 52% of revenue comes from 5 customers, and currently, so all 5 of those customers are in the mobile devices market where we already experience low margins. So if one of those customers was to drop us, then that would reflect poorly in the income statement as well. And so yeah, to summarize the presentation, I mean, there are 2 main reasons that I recommend Synaptics as a buy. So Synaptics is currently repositioning itself favorably into the emerging, and I would consider revolutionizing, Internet of Things market. And 2, when compared to its peers, Synaptics is the cheapest stock to buy, and it has the most promising outlook for future growth. So that's the end of my portion of the presentation. I'll go ahead and open the floor for any comments or questions now.
Colton, how susceptible is Synaptics to a competitor doing what they do?
Right. So
how competitive is this market?
I look at this market. I think everybody's familiar with Qualcomm. Probably, I would say, or a lot of people are. Qualcomm is definitely a big competitor with Synaptics, and I would also compare this market to something like Apple and Microsoft, like especially with the expected growth that we're seeing here.
Yeah,
there's definitely room for more than one company to thrive.
So Colton, I think maybe what he was getting at, if I understood correctly, Bento, it's more about what kind of protection do they have? So it's patents, something like that. What's to stop someone else from coming in and doing the same thing?
Oh, okay. Well, I do know, I didn't put this in my presentation, but I do know that Synaptics does have about 1,800 active patents right now, and that's on top of a little over 700 pending patents. So they own a lot of intellectual property, and they put about 300 million, I think it was, like roughly 300 million every year into R&D. So that's going to help them keep their competitive advantage as well.
Colton, this is Frank Butler, Dr. Butler over in management. One of the challenges I have with a company like Synaptics, and they've been around a long time, but they're typically a hardware manufacturer, right? Their focus is very much on hardware. And you brought up Apple and Microsoft, and Apple and Microsoft write the software that utilize the hardware. The one concern I have is margins, right? So anytime you're in the hardware side, and you're not controlling the stack, you start running into some real challenges with profitability, right? Because they're going to get the margins on the Apple side, Microsoft side. I mean, if we look at their gross margins, for example, I mean, we're talking about 38 to 68%, depending on Apple or Microsoft. Is that of concern that because even though they might go hard into IoT, and there's a lot of competition right there right now, it's in the really early growth phase of that industry, is there concern that because of Synaptics size and also because of their sort of inertia within their stack of supplying about their long-term profitability versus somebody else might come out with something better?
Yes, sir. I would say, yeah, there is a little bit of maybe a long-term concern there, because kind of the same thing that happened with the mobile and PC devices, that the technologies that Synaptics were putting into those devices, say 10 years ago, they had higher margins than they do now, and that's because more and more competitors come in. You see competitive pricing. You see companies like Apple who have I mean, they're making the technologies in-house now, so they're not even going to a supply chain like Synaptics or Qualcomm anymore. So maybe we will see companies like Amazon. I could see definitely doing that, or Apple doing that with some of these Internet of Things technologies that we're seeing right now. So that is definitely something that I would look out for in the long term.
Well, what's your time horizon on this? 1 year, 2 years, 5 years? What do you feel comfortable with as far as if we were to put an investment into this stock?
Yeah, I would say comfortably that Synaptics is going to keep growing until the year 2027 and maybe keep expanding after that.
See, I think that still I still kind of get hung up on it a little bit. You know, you have now these programs that works with Alexa, you know, works with Google, Apple HomeKit. You know, all these Internet of Things are being stacked under these branded forward kind of companies, the ones that are actually connecting to the end users. Again, you know, Synaptic has been around for a long time. They have a new CEO as of last year. And I think there's a lot of reorg going on. My concern in the IoT side, you know, if it was so successful, you know, Broadcom being who they are, offloading that part of the business to Synaptics sort of already gets me hesitant to begin with, because Broadcom was sort of ideally placed with their chip end of things, but I know they're focusing out much more in that wireless segment. But you know, they've offloaded these things like Bluetooth and what have you, and I'm not really. I get concerned a little bit, especially in that long, because there are so many companies right now already in this IoT segment, and all of it's getting pushed underneath that you know, Apple HomeKit works with Alexa, you know, the Google aspect of things, and so that's my concern, is that are they going to just get lost in the noise? I think they bought themselves in right now, but the problem is, are they going to be able to get any headway and really make the margins out of it because of that lack of the end user actually understanding that they're actually there and focusing more on the price?
Yes, that's definitely something to keep an eye on going into the future. These next, especially I think this year, we're going to start seeing whether they win some of these big contracts with some of the bigger companies. And if they do, then it's going to bode very well for this company. And I think that they will. They've won some pretty notable contracts recently in the past few years, especially internationally. And you know, China and those countries over there in the Asia and maybe some the Europe and Africa regions, they usually lag a little bit behind America when it comes to the innovation and technologies and stuff like this. But they're really not in this day and age, and when it comes to the Internet of Things. So this is definitely a global industry. I mean, of course it is in the first world countries that you see this stuff, and it's definitely discretionary. So as the market fluctuates, as the economy is either good or bad, you're going to see dips or rises in the sales of these products.
Do we have any more questions for Colton? I'm just going to try to keep us going on pace if we do not. Excellent. So Colton, I would advise you to maybe have a conversation with Dr. Butler. I think he's got some experience in this sector, and go ahead and send your full report to him. I think you could get some valuable feedback there. Thank you, Frank. I appreciate it. Let's go ahead and move on to our next analyst.
All right. Good morning. My name is Luke Johnson, and I'm a lead analyst in the energy sector. And today I'm going to be presenting Enphase Energy as a buy. So I believe this is a buy because they're the lead supplier of microinverters. They've experienced strong financial growth. They are the better option for expansion in power needs, and they stand to possibly gain from the upcoming presidential election. Obviously, they've experienced strong price growth. Could you go back real quick? Obviously, they've experienced strong price growth through the last 5 years, but I will now explain why I think it's still a buy. Next slide, please. So just a quick overview of the company. They're a manufacturer of solar power solutions designed to increase productivity and reliability. They also sell mainly to installers and to suppliers internationally. Next slide. So here's their Enphase IQ system. Their major selling point is the microinverter technology, which converts the sun's energy to AC power for your home at a panel-to-panel basis. This power is then stored in the in-charge storage system, and you can track this power creation through the Enlighten apps on your mobile devices. So why would installers choose to offer this to their customers? Well, it's very user-friendly with this Enlighten tracking system. It also has a much easier installation, as it's 34% lighter than previous systems and up to 2 times faster. It also offers easier connection to multiple roofs with their new Q cable. Next slide, please. Okay, so their competition. In the inverter market, their main competitor is SolarEdge. SolarEdge offers an optimized solar inverter, which has one singular inverter for all of your panels compared to a microinverter with Enphase on every single panel. SolarEdge's technology is tougher to expand if your energy needs increase, as to Enphase, which offers easy expandability if your needs for power increase. Also, as you can see through this chart, the annual global PV new build has increased substantially, which is basically the solar market. And as of now, SolarEdge controls roughly 60% of the US residential PV inverter market share, while Enphase controls roughly 20%. Also, if you look at the string inverter versus the microinverter chart, here, the microinverters, if there's debris on your panels, the rest of your panels are operating at full capacity, while with a string inverter, if there's debris, all of the panels before that will not operate at full capacity. So obviously, like I said before, Enphase's microinverters are better if you need to expand with your power needs. And one main driver for expansion, I believe, will be because of the electric vehicle market. Next slide, please. So here's the electric vehicle market forecast through 2040. So with electrical vehicles market growing, this will increase the need for power in homes, making Enphase the better option when compared to SolarEdge. Next slide, please. So with the expansion with this company, 10% of their net revenues were allocated to research and development in 2018, along with 6% in 2019. They protect this by having 233 issued US patents and 77 foreign issued patents. So as you can see with the revenue by geography, the United States makes up the majority of their revenue, but international markets are very important. So a recent partnership in Florida was with SunCool Energy Company, and Florida is a very target area because of their climate. Also, internationally, they are working to install their products in PepsiCo Thailand, and also in Europe, they have recently partnered with, could I get the next three? Solar Clarity, Libra Group, and Carbomat Group. Next slide, please. So for the financials, Enphase has averaged 20.5% growth per year in revenue in the last 5 years, with a 97.4% spike in their revenues in 2019. Along with this revenue growth, they've experienced a gross profit increase at an average of 35.18% per year in the last 5 years. And as of Tuesday, they had a 25% earnings surprise with an earnings per share of 30 cents. Also, their earnings per share are forecasted to keep growing through 2021 and beyond. Next slide, please. So just continuing with the financials, they are financing their debt well, as their cash and cash equivalents have increased to $251 million, while their net debt has decreased to negative $133 million. Next slide. All right, so obviously there's going to be some risks with this investment. It has a beta of 1.513, and emerging technologies could pose a risk to Enphase, as there is no widespread adoption of one singular form of alternative energy at this point. Also, startups could pose a risk if new technology were to emerge. And also, Enphase uses limited suppliers that have quarterly negotiation of their prices. This could stand to benefit or hurt Enphase. As well, these suppliers use raw materials for these productions, including copper, aluminum, silicon, and petroleum, which also include fluctuating prices, which could again help or hurt Enphase. Also in 2019, 2 customers accounted for 33% of Enphase's total net revenues, increasing their bargaining power. Next slide, please. So their COVID exposure. Enphase's main contact manufacturer, Flextronics, has fully restarted their operation in China with very limited issues. California has also deemed the solar industry an essential service, and the installation of Enphase's products limit person-to-person contact while doing the installation. Also, many of these installers have taken on a virtual sales approach, limiting coronavirus exposure. Also, with the upcoming election, A Democratic win in the presidency could possibly boost the solar industry as a whole, which would benefit Enphase, while a Republican win still has a limited negative effect as they have experienced growth throughout the Republican control the past 4 years. Next slide, please. So for my valuation, Enphase has experienced a net profit margin of 23.5% compared to their peer median of 0.2%. They have also had 14 positive sales growth quarters when compared to the peer median of 12. As their PE is 104.28, it is forecasted to reach 43.83 by 2022, mostly due to the forecasted growth in earnings per share. Their inventory turnover is also much higher than the peer median, and when comparing their PEG ratio to their main competitor in SolarEdge, it is only 0.03 higher. Also, in my assumptions, I calculated my WACC with a 98.20% weight in cost of equity and a 1.8% weight with the cost of debt. That gives me a WACC of 15.2% and an interim growth rate. Oh, and I calculated my interim growth rate of 72.14% using a mixed calculation with the implied PE growth rate and the implied FCF growth rate. Also, my terminal growth rate sits at 3%.
Okay, same question. How many years are in your interim growth period?
Yes, sir. My interim growth period, I used 3 years.
And they're growing 72% each of those years?
I believe that that is possible with the growing revenues. And I also added in a mix with the implied PE growth rate, which lowered that free cash flow growth rate.
Uh-huh. And what's the revenue growth rate?
I'm sorry, I did not include that in here.
Okay,
But
well, for it to grow cash flow, it's, well, anyway, same suggestion. Will you contact me offline? You can go to Dr. H or somebody else to get my email. And I'd like to take a look at your DCF.
yes, sir. Will do. All righty. If there's no more comments, I'll move on to the next slide.
I had a question about how much they're investing in R&D.
Yes, ma'am. I discussed that in a few before. In 2018, it was 10%, and in 2019, 6%. And that has been increasingly lowering through the past years as they're looking to expand with their current technology in international markets more.
Because one big complaint with retail or with residential systems is the battery, the expense of the battery and the inefficiency of the storage. And so it concerns me that they are reducing how much they're spending on R&D. I wanted to make sure that I'd heard that correctly. So thank you for repeating it.
Yes, ma'am.
I still am struggling with the 72% interim growth. Can you shed a little bit more light on this?
So obviously their financials have been growing pretty rapidly over the past few years as this is kind of a new industry and they're the leader in microinverters. I understand that is a high growth rate, but discount using the free cash flow implied growth rate along with the implied PE growth rate, I believe that mixing these two, that growth rate is possible with the next 3 years.
Believe it or not, Bento, he's tempered that down a bit too. I think he put in a few more conservative measures. The first time I saw that number, it was well north of 100%. So
it just seems to me like, if it's a number that's so far out of what one would consider normal, typically, we probably should dedicate a slide just to motivating that number.
Yeah, I agree. Thank you for the comment.
How much of kind of your growth rates and your assumptions are based off kind of the, I'm not exactly sure which year, but I know the tax credits on these solar panels are going away. How much of that is kind of baked into this, the next 3 years versus kind of your terminal growth rate?
Correct. So the tax sunrise actually does end after these next 3 years. It is continually lowering through 2023, but I believe with its expansion overseas, I believe it will expand overseas. So I did take that into account.
Okay. Just as a general DCF type comment, I think we need to be ready to answer a question like why 3 years for interim growth or 1 year as the previous analysts put in, there's got to be some rationale for the interim growth period apart from the interim growth rate. Because when you slap that terminal growth rate on the model, it dominates the value. And so it's really important to be able to figure out what that interim growth period is going to be and why it needs to be what it is. A more general question, Melissa, perhaps for you is, how are we just borrowing a beta from Bloomberg, or are we calculating our own betas?
For this set of reports, it was through Bloomberg.
So we're using a standard methodology for beta.
Yes, sir.
That's kind of what I wanted to get to. Okay.
Yeah.
Thank you.
And
yeah, sometimes, Bento, we try to calculate our own with some of these strategic fund, mid-cap, small-cap companies. The data itself, it doesn't lend itself to calculating beta. Sometimes you don't even have enough years if you were trying to do a 5-year beta or something like that. So I kind of understand why they want to just keep it steady and rely on Bloomberg, but it's a good question.
Yeah, I don't have a problem with that necessarily. I think there's something to be said for consistently using a methodology for beta across analysts,
And quickly, I'd like to comment on what you just previously said. I use the 3-year interim growth rate period because of that tax sunset we were just discussing with Shane. People are trying to buy more solar while they still have tax incentives through 2023. So I believe they can continue this growth through that interim period. All right. Any more questions? There we go.
I have a quick question really quickly on what you just said. So you've just said that they're looking to buy during this tax credit period. So let's say the tax credit's taken away. What happens then? Is that how you factored your bear case? So we have no additional tax credit. What does demand look like without a tax credit? Did you factor that in anywhere?
I don't. I more factored that in theoretically. So I would say if the tax credits go away, I believe there will still be an established solar market that will still look to use Enphase and their products. So
do they do servicing on existing solar panels, or is it only new installation? Because my concern is if it's only new installation and then the demand for new installation drops, would that not have a major negative impact on the company's operational performance?
Right. That's a very good question and a possibility that we should definitely take into account more in our bear case. All right, so to conclude, I believe Enphase is a buy because it is the lead supplier of microinverter technology. This technology is much easier to expand with growing power needs when compared to their competitor in Solar Edge. They've also experienced strong financial growth with limited coronavirus exposure, and they stand to gain from the upcoming presidential election. So if we have any more questions.
Considering where we are, let's go ahead and put those questions in the chat box, and let's go ahead and get to our last presentation. Thank you all for your patience. We're going to try to end this, as always, by 12:30.
Thanks, Dr. H. Hi, y'all. I'm Lena Chestnut. I'm a lead analyst in healthcare, and today I'll be doing an industry overview on the clear dental aligners industry. So specifically, we'll be looking at companies Smile Direct Club, Candid Company, Invisalign, and Uniform Teeth, but most specifically Smile Direct Club and Invisalign, because they are the only public companies in this industry right now. All right, so just a quick product industry overview. So the product that it offers is invisible tooth alignment, which avoids the traditional metal mouth appearance of braces, and it caters to patients of all ages. So it's a subgenre of the cosmetic dentistry industry, and it is gaining speed quickly because of the accessibility through internet. So there's an increasing number of subscription-based services, like you see here, this box from Smile Direct Club. You apply online and you can receive a clear aligner in a matter of weeks instead of having to make consultations, appointments, see an orthodontist, possibly see multiple orthodontists. And it's a much more streamlined, easier, efficient process. According to Health and Medicine Week, there is an expected 16.15% compound annual growth rate for years 2018 to 2023. Now, this has been affected by COVID, needless to say, but we are still seeing steady growth in this industry. So you can do the next slide, Melissa. So zoom out and a look at the cosmetic dentistry industry. So like I said, the clear aligners industry is a subgenre of the cosmetic dentistry industry. And there are three leading factors for this growth that you see here. So according to current analysis by Reports and Data, the global cosmetic dentistry market was valued at $18.79 billion in 2018 and is expected to reach $32.73 billion by the year 2026 at a compound annual growth rate of 7.2%. So there are three primary leading factors for this growth right now. Number one is increased tooth-related diseases worldwide and in the US specifically, an increased global geriatric population that requires more dental care than a younger person, and increased popularity in dental tourism, which is basically when North American citizens go to other countries to receive cheaper dental care, since dental care is so expensive in the United States and in Canada. So this is really globalizing cosmetic dentistry, whereas before it wasn't as popular in other countries. You can go to the next slide.
Lena, may I interrupt real quick?
Of course.
Are you on the CFA Challenge team?
Yes, sir.
Okay, look forward to working with you on that. Your previous slide, or no, this slide says the cosmetic dentistry market was valued at 18.79, and then you say it's expected to reach 32.73 billion. Those are revenues, right?
Yes.
Not market values, right? It's you're talking about the revenues for the industry.
Correct.
Just want to be sure. Okay. All right.
Yeah, sorry.
That's all I had.
All right. And a continuation of the overview of the clear aligners industry. So the market reach is highly competitive since there are just a few companies that provide this product. There's about 10 really competitive companies in the market right now. I wanted to focus specifically on Invisalign, Smile Direct Club, Candid Company, and Uniform Teeth, just because they are the highest performers right now. There's a diverse customer demographic because they do focus on a direct-to-consumer business model, which means that there's a continuously expanding market base. Basically, because they are so accessible through online services, they have a continuously expanding market base. You can do the next slide. So this is just a quick regional analysis so you can kind of visualize. So according to Grandview Research, North America takes about 57.6% of the revenue share, with Europe and Asia Pacific respectively following. And this is likely because 85% of North Americans view dental care as essential. So about 4 million North American citizens have braces, and 25% of those are adults. So that's another reason why the clear aligner dentistry is super beneficial right now. The more adults that get braces, the more discreet they'll want them to be. The less likely they'll want the traditional stigma of someone with adult braces with metal in their mouth. It's less professional, and less sophisticated and also less convenient. So you can do the next slide. So I just wanted to share this really quick with you. These are some other innovations besides just clear aligners that companies, specifically Smile Direct Club, is working on. So all of these products that you see here are sold in addition to their clear aligners, and they're all patent protected. So they're this competitive advantage is super high. So on the far right is really what I would like to point out specifically. It's called the Smile Spa. And where you see these tile and Bluetooth logos, this is a Bluetooth connected tile protected aligner case that also cleans your aligner. So Tile, if you're not familiar, is an app that you can download on your phone, and it basically through Bluetooth tracks any device that you have connected to Tile. So this aligner case is impossible to lose, which is super competitive with traditional orthodontics. When you receive a plastic retainer after you get your braces out, it comes in a cheap plastic case that you can easily throw away or misplace. So this patent protected aligner case is super innovative and highly competitive. They also provide, like you can see, this electronic toothbrush, which is the second highest growth contributor by a manufacturer in the electric brush segment. They also offer further care. So you see these bright on and whitening and sensitivity toothpaste and services. So after you get your clear aligner, there are multiple services that you can take advantage of that are patent protected and highly competitive that will really further your smile, unlike other orthodontist work where you would have to continue to pay premium prices and wait a long time to receive an appointment to get these services. Also, all of these products are available on walmart.com. So they're really trying to push the customer demographic of all people. So this is not some high-end service, it's high-end products that are going to be accessible to everyone. So they're really shooting to be the Amazon of cosmetic dentistry in this industry. So you can go to the next slide. So I just wanted to touch on some COVID-19 impacts because obviously that's really important. So you can click the slides for these animations, Melissa. Thank you. So like I said, those products are available on Walmart. That's a very recent deal that was sort of taken a pause with COVID-19, but they're just now starting to offer those products via Walmart.com. You can also see CVS Pharmacy and Walgreens in multiple states and in some Canadian areas, where you can get a 3D print of your teeth and see your aligner super quickly. I wanted to touch on the lipstick effect, which during COVID is being called the Zoom boom, which basically means that.
Is it just me, or are y'all having a hard time hearing Lena?
No, it's not just you.
I think she's breaking up.
Lena, please.
Their physical appearance.
There you go. Perfect, Lena.
Can you hear me now? All right.
Yes, I can hear you now.
I'll just start the slide over just to be safe. Awesome. All right. So just wanted to touch on the lipstick effect. The lipstick effect is a phenomenon where in times of crisis, people are more likely to spend on their physical appearance. In the past, in World War II, during 9/11, during the 2008 recession, it was physical cosmetics like actual lipstick. But during 2020, we're seeing something that theorists are calling the Zoom boom, which is higher demand for cosmetic aesthetic dentistry and surgery. So more people than ever right now are getting braces because they can hide them underneath their masks. But a benefit to the clear aligner is braces usually take longer than just a few months or even sometimes more than just a year. So if you need that clear aligner, you don't have to be self-conscious under your mask. Also, these direct-to-consumer innovations through Smile Direct Club, Uniform Teeth, Candid Company, and similar other companies provide contactless services that don't require paying through insurance, that don't require going into an office physically. It's just overall way more accessible. So you can go to the next slide. So I just wanted to share this little cost breakdown with you that I really believe visualizes the competitiveness of these companies in a really wonderful way. So as you can see, sorry, these numbers kind of got shifted around, but Smile Direct Club is $19.50. Now these prices that you see here are flat prices. So when you get traditional braces, they can scale anywhere between $3,000 and $10,000, averaging at about $6,000 to $7,000 before insurance. So when you pay this flat rate of $19.50, you are promised your clear aligner for as long as you need it. There's no scale of price. So this is really beneficial to their business goal of becoming the Amazon of cosmetic dentistry. So when they sell to the to the absolute maximum of customers possible, they can really profit faster, because as you can see from this graphic that I took from Candid Company's website, they cut out the clinical overhead, they cut out office visits, and they cut out clinical markup. So their fixed costs really, there's only a period of time where they have to cover their fixed costs, and then they can become indeterminately profitable. So these numbers really got switched up on this PowerPoint. So just to clarify, Melissa, if you want to hit the animation a couple times. So I'm going to focus on Smile Direct Club for the remainder of this presentation, but just to clarify these numbers, that 7,000 you see above Candid Company is actually belonging to Invisalign, the 2,750 belongs to Candid Company, and then the 2,400 belongs to Uniform Teeth. So opposed to the $6,000 average of traditional braces before insurance, you can save $40.50 with Smile Direct Club. You can save $3,600 with Candid Company and $3,250 with Uniform Teeth. Now, Invisalign has that price of $7,000, and that is because they are they really spearheaded this clear aligners industry. They went public in 2001, so they still require that you go through an orthodontist. So that's why companies like Smile Direct Club, Candid Company, and Uniform Teeth with direct-to-consumer business models are way more futuristic and much what we would like to focus on the most. So you can go to the next slide. So I just did a quick Porter's 5 Forces on Smile Direct Club to look at the industry. So Melissa, if you want to hit the first graphic. So the threat of new entrants is pretty low, because you can look at whether people want to purchase a direct-to-consumer product like Smile Direct or traditional braces, but really those are the only options. So there's two options, and if you're looking at simply cost, Smile Direct Club, and simply cost and convenience, Smile Direct Club is the best option. The American Dental Association is really fighting against these direct-to-consumer business models, which I'll get to in the threat of substitutes part, but I just wanted to touch on it really quick because some people may want an actual specialist. So that threat of new entrants for companies like Smile Direct Club is low because they have so many patent protected products, but it may be a little bit higher if you're looking at getting traditional braces. Bargaining power of suppliers, Melissa, if you'd like to hit that graphic for me. So the bargaining power of suppliers is also low for these direct-to-consumer models because they are the supplier. So they don't have to go through this clinical overhead. They don't have to go through orthodontists taking chunks of the money. So the bargaining power of suppliers is pretty low. But for the same reason, Melissa, you can hit that graphic, the bargaining power of buyers is pretty high because these direct-to-consumer models depend completely on the number of customers they have. And then Melissa, if you'd like to hit the other one. So the threat of substitutes, Sorry, we're running over our time. I just saw that chat. The direct-to-consumer approach, like I said, some people just prefer to have a specialist, but many of these direct-to-consumer options offer virtual chat 24/7 with an orthodontist, where you can send them pictures of your teeth, or you can ask them constant questions, or you can even Zoom with them. So during these times and during the future of healthcare, which is likely to be heavily reliant on teledentistry and telehealth, this really isn't that bad. And then the degree of rivalry is probably high just because this is such a new industry. Smile Direct Club is really the leading an industry, and it's also the only public company of its kind. And so the degree of rivalry in the next few years, I would say, is probably pretty high. However, if Smile Direct Club and similar companies continue constant innovation with patent protected products, it's likely to be lower. So you can go to the next slide.
I'm going to pause just for a second to tell you that we have hit our time limit. If you have questions, we're not going to probably have time for a long, lengthy Q&A after this. I will let her finish her presentation. But if you have any questions you want answered, you can put them in the chat box and we'll make sure that they reach out to you directly. She's only got a couple of slides left, so we'll let her wrap up real fast here. But if you do have to leave, I do understand. It looks like you were right, Ray. We ran a little bit long.
Yeah.
I just put my email in the chat box if you would like to send me directly any questions or comments about my presentation. Again, I understand if you have to head out. But here's just a quick relative valuation of the industry. Here, these companies with asterisks, these are all medical device companies. So we wanted to have these as proxies for the industry because, like I said, Smile Direct Club and Align Tech, which owns Invisalign, are the only publicly owned companies in this industry at this time. So I wanted to really, Melissa, if you'd like to hit that graphic, just focus on the profit margin. So the industry average has a profit margin of negative 9.58%, and Smile Direct Club's profit margin is at negative 11.09%. So for only going public about 2 years ago, that's really not too bad. It's only a little bit under the average currently. And if you look at Align Tech, which has been public since 2001 and again owns Invisalign, it's got a profit margin of 16.81%. So that's a really excellent profit margin. And I really see Smile Direct Club moving that way very quickly. So you can move on. I also did a rule of 40 analysis just because there really aren't very many public companies in this industry right now. And because Smile Direct Club is so newly public, I thought it would be helpful to visualize. So the rule of 40 basically shows the relationship between a growth rate percentage and a profitability percentage, which I used for EBITDA for. And the closer that number is to 40%, the better. Ideally, it would be a little over, but I wanted to compare Align Tech and Smile Direct Club for this rule of 40. So Align Tech has a rule of 40% of negative 52.8, but Smile Direct Club has a rule of 40% of negative 27.6. So I really thought that this showed an example of how quickly it's growing as a small business. So if you can go to the next slide. And here's just some leftover remaining numbers really quickly. So according to Smile Direct Club's second quarter report, there's an EPS of 0.25. And then this statistic I thought was really important to prove how quickly companies like Smile Direct Club are growing. So sales and marketing expense of $35 million in the second quarter, or 32% of revenue, as compared to 72% of revenue in the first quarter of 2020. So this improvement of 55% really proves that Smile Direct Club is having to spend less on actually getting their name out there. And they can work more on becoming profitable as soon as possible. They have a net promoter score of 57 compared to 1 for the dental industry or 37 for Invisalign. Now, a net promoter score is basically how likely patients or customers are to promote this company. So this is a really positive thing. And I thought it was important to include simply because of the direct-to-consumer model that is highly reliant on internet. Almost all of their ads come from Instagram and Facebook instead of physical ads. So this net promoter score is really valuable to their company. And then while Smile Direct Club is currently unprofitable, its profit margin is only negative 11.09%, which really isn't too terrible when you think about how quickly it's growing and how new it is and how newly public it is. So you can go to the next slide. So I just wanted to conclude with these 3 bullets for an outlook. This is a prime time to invest in companies like these that you see here. There's promising long-term growth, and it truly is the future of cosmetic dentistry. It truly will be the next Amazon. It's hugely accessible, quickly growing, many patent protected products available, and overall just a really promising industry to be looking at. So thank you for your time. My name has been Lena Chestnut.
Thank you, Lena. Thank you to all of our presenters. You've all done a fantastic job. If you have any questions for Lena, please post them in the chat box or email her, or you can email me. My contact information is at the very top of the chat box. I just want to say thank you. We did actually, I believe, hit 100 professionals because we had a few drop out early and a few come in late. 100 people. So I think a little over half of those were students and a little under half of those were guests. We had professionals from banking like Mike Kramer. We had longtime supporters like Fred DeCosimo, lots of members of the UC Foundation board, our own professional advisory board, and our junior advisory board. So thank you all. They represented, and this is not an exhaustive list, but just what I saw offhand: TVA, Unums, Solomon Wood, Oakland Consulting, the Patent Group, Patent and Patent, the Northwestern Mutual, Patent Albertson and Miller, ACA Compliance, Fisher Investments, Acumen, Bloomberg, and we had folks from California, Georgia, Texas, Maine, New York, and probably a few others that I did not see. We had a lot of our UTC faculty and staff, including the Dean of the College of Business. And I just want to let you know that you guys play a key role in making the Smile Fund what it is. We really appreciate your support and your participation. Thank you all. And hopefully this has been a strange year and the students have done incredibly well this year, given everything that has happened. The outperformance is very important, but I also like their process and their improvement that they're putting into the strategic fund. So well done to all of the students in the Smile Fund, especially the officers. Thank you all, and I hope you have a wonderful day.